Hello and welcome to Market Domination. I'm Josh Lipton alongside Alexandra Canal, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I do think there will probably be further price cuts, and it's an ironic situation that goes against the normal microeconomic expectations. So in China, when companies cut prices, in this case, many consumers say, let's wait and see. We don't think it's at the bottom yet. So it interestingly hasn't sparked the demand that we would normally expect when you cut prices.
I think what the market is telling you, what the bond market is telling you, is that we're in price discovery mode. I think the market is really trying to get a better sense for what higher for longer means in the context of a Fed that now may not cut this year.
They continue to invest. They actually think that they are going to be compensated on the halving, the fact that they're now getting half of the price. And I don't think we are going to see the market sort of dropping, at least this is not what they're expecting.
We've got 1 hour to go until the market close. Let's do a check of the major indices sponsored here by Tasty Trade. Look at this. We've got a rebound in today's trade. Green across the screen here. Of course, that's after that pullback we saw last week. Investors were rethinking and repricing the Fed's path to cutting rates. Geopolitics, of course, was also front and center. But today's a different story. We got the Dow up about 1%, 360 points. Let's just get a check of the tech-heavy Nasdaq. That's also in the green, up about 1.4%. And find the broad gauge, the SPX, S&P 500, also about 1.2%, tacking on about 60 points. Of course, this week, different story. Investors have a lot on their calendar. You got earnings, including big tech earnings. What do those mega caps have to say about the quarter? And more importantly, what are they going to tell us about the quarters ahead, guidance and forecasts? Also, big economic data as well. You got GDP on Thursday. And remember, you got PCE. That is the Fed's preferred inflation gauge on Friday, Allie.
Yeah, that's right, Josh. Stocks in the green today as markets attempt to rebound from their worst week of the year. For more on the latest market action, we want to welcome in Jill Carey-Hall. She's Bank of America's senior U.S. equity strategist and head of U.S. small and mid-cap strategy. Jill, thank you so much for joining us. So today, at least, we seem to be coming off of the rut that we saw last week. But how do you view the market's recent downbeat trend? Is this a correction that was needed in stocks, or do you think this is more macro as the path forward for rate cuts remains murky, along with some of those escalating geopolitical risks overseas?
Thanks for having me. Well, look, I think we hadn't seen a 5% correction or 10% pullback in the market in some time. Usually 5% S&P 500 pullbacks happen about 4 times a year. 10% corrections happen about once a year. So it had been a while since the market had seen any significant pullback. I also think we're in earnings season now. Investors are going to be focused on the outlook for guidance, which has been weak. Usually it is seasonally weak at the start of the year, but we'll see if that improves as more companies report. Obviously, we have geopolitics and inflation data that's continued to come in hotter than expected, which we do think many large cap corporates can still hold up if the Fed doesn't cut as soon as some investors may be expecting, but it could prove more challenging for some segments of the market, like U.S. small caps, at least for the near term.
And Joe, you mentioned those hotter than expected inflation prints. We have PCE on Friday, of course, the Fed's preferred inflation gauge. What are you expecting there, Joe? How important is that data point for the market?
Well, I think investors are going to continue to watch the inflation data that feed into what the Fed is looking at. And, obviously January, February, and March, we generally saw inflation data that surprised to the upside. So our economists at B of A had pushed out their expectation for the first Fed cut to December of this year instead of June. So, against that backdrop, we think the Russell 2000 small cap index may be more challenged to outperform until we can get more confidence that inflation is easing. The small cap index does have a lot of refinancing risk. You have, more than 40% of the debt for that index is either short-term or floating rate. But I still think that given the macro picture, there are a lot of positives for, stocks that are more GDP sensitive, more sensitive to the manufacturing recovery or higher commodity prices, that don't have as much leverage or, are as exposed to refinancing risk. So I still think there are pockets of small and mid caps that could be poised to do well near term, but overall that's one reason that the index may be challenged until we get a little bit more confidence that inflation is starting to more sustainably ease.
And Jill, what are those pockets with small and mid cap companies? How would you advise investors to best position themselves there?
Yeah, I think when you look at it by sector, some of the sectors that are more exposed to the GDP, manufacturing recovery, to higher commodity prices, but that have less refinancing risk would be energy, industrials, materials, so the commodity complex. And I think it's an environment where it makes sense to be active rather than passive, pick stocks and sectors, given some of these risks to many small and mid-cap corporates. We do still like value over growth. But, again, I think large cap value may be a bit more insulated near term if rates stay higher for longer. But, the ISM is now back above 50. Manufacturing conditions have improved. So, that is bullish for a number of small and mid caps that, don't have a lot of leverage on their balance sheets.
As the earnings come in fast and furious this week, Jill, I'm just curious, and you're talking to clients, what do you see as sort of the risks for the remainder of this earnings season? Is it the sticky inflation? Is it the strong dollar, geopolitics? Is it all three, Jill?
Well, I think, as we look at the consensus projections for profits growth for this year, a lot of the profits recovery is very back-end loaded. Small cap earnings, for example, are still negative year over year this quarter, and then we see a continued improvement throughout the year, especially in the back half. So, I think just corporate guidance overall will be very important if companies can continue to surprise to the upside. If we see demand coming back, given in prior quarters, we had seen a lot of, margin-driven earnings growth, but to actually see sales recover, I think that will give investors confidence in the back-end loaded earnings recovery that's being forecast for this year.
And what about longer term? We have an election coming up. Do you think that's something that could spur volatility as we close out the year?
I mean, in general, we've seen that volatility does tend to pick up within the market in the months ahead of the election. But I think, for equities, if we get to year end and if we're able to see confidence in the, continued profits recovery, if we are able to see, inflation easing so that it looks like the Fed is able to cut, particularly for small and mid caps, that could potentially set us up for a better year end. Certainly there'll be election issues that'll be impactful to investors, but what we found is that the overall profits and economic backdrop tends to be a much bigger driver of differences in returns than political parties. So we think the macro backdrop will continue to be an important driver of equities in a year where earnings should be more bigger drivers of performance than just multiple expansion, which was more what drove returns last year.
And Joe, we're talking earnings and valuation and Fed. What about seasonality, Joe? How much weight do you put on that? Sell in May and go away?
Well, I think certainly there'll be some seasonality to equity market returns and to profits, contributing to kind of the big 4Q pickup that we see. There'll be months in the year that do tend to have more seasonality, but I think this year in particular, the factors like the inflation backdrop and the Fed and the macro data will be important drivers of the trajectory of equity markets from here. And we do expect further upside to the S&P 500. We have a 5,400 year-end target. And again, I think it's going to be a story of earnings coming through this year, of demand recovery. Certainly geopolitics and will be a factor to watch, but modestly higher oil prices could be positive for areas like energy. If you do see oil prices continue to rise, that can hurt more of the lower end retailers, consumer staples. That's one of the reasons we're more positive on consumer discretionary than consumer staples sector.
And Jill, we talked the Fed a few times. I'm hearing increasingly that there is a possibility that we could see no rate cuts this year. How will that impact something like your S&P 500 target or even some of those small cap names?
Well, I think, look, we've gone from 0 to 5 on rates, and the S&P 500 companies have been able to manage that. We've obviously seen margins impacted, but companies have been able to exercise pricing power in many cases. Now, obviously, if rates were to continue to move higher and inflation were to continue to move higher, this becomes more and more challenging. Some companies have cited it, you can only raise prices so many times. But I think, if we're on a path to inflation starting to ease, whether it's a cut in December or potentially next year, that should still be a positive. That said, if we're on a higher for longer rates path with, uncertainty over whether cuts are in sight, we think that large cap corporates are much better able to manage that than small caps, where, for the S&P 500, about 80% of the debt is long-term fixed rate debt. Companies were able to lock in, low rates, whereas for small caps, only about 45% of the debt is either short-term or floating. So this becomes a bigger and bigger earnings impact, especially as you go out to 2026 and beyond, when a lot of debt is coming due.
Jill, thank you so much for helping us kick off the show. Appreciate it.
Thank you.
We are just getting started here on Market Domination. Coming up, the fourth Bitcoin halving took place over the weekend, and we'll chat the rising optimism in the cryptocurrency space on the other side. Plus, the United Auto Workers notched a big win with Volkswagen. We're breaking down what's next for UAW later in the hour. And several of the biggest tech names on Wall Street are slated to report earnings this week. We're going to look at how to best navigate the big picture with today's Yahoo Finance playbook. All that and more when Market Domination returns.
Bitcoin prices are slightly up just days after the fourth Bitcoin halving took place. For more on what the halving means for the cryptocurrency and those Bitcoin miners, we're joined by Taras Kulik, founder and CEO of Sunnyside Digital. Taras, thanks so much for being here. Bitcoin prices above 66,000 today. Typically, we do see prices rally about 12 to 18 months after each halving, but we've seen such a run up in the price action this past year as we've seen these launches of the crypto ETFs. So how do you assess what's already been priced into the price of Bitcoin versus how much room there is to really run here?
Yeah, that's a great question. Multi-layer, actually. What we've seen over the past few months, really this massive rally that's come up to the halving, I think has been driven by a lot of macro, a lot of geopolitical instability. You look at the amount of capital flowing into the ETFs, that ETPs that were finally launched and approved by the SEC in the United States based on the courts getting involved. Really being the catalyst to a lot of that pricing upside that we've seen year to date, as well as over the past 3 to 4 months in 2023 at the back end. The confidence that we're seeing now really is in, I'd like to think, the developer and transaction fee activity that we've been seeing on the Bitcoin protocol since the halving. In fact, several different type of new protocols have launched on top of the Bitcoin network, which have been really driving the transaction fee value that's providing the economic backstop for the mining ecosystem that my company, Sunnyside Digital, supports.
Taras, I'm also curious, just, listen, you know this space so well. Was there any kind of meaningful differences, Taras, between this halving and previous ones? Anything that kind of distinguish it, set it apart?
Yeah, massive. The key differences are really the adoption integration of Bitcoin into overall global portfolios. We're seeing massive sovereign wealth funds, ultra high net worth individuals, countries themselves getting involved in Bitcoin. And I'm not talking about El Salvador, Bhutan, but major global players are looking at Bitcoin as not necessarily an alternative to gold, but a supplement to gold as we see the headwinds in geopolitical risk globally. What they've also really come to appreciate is that this truly is a decentralized, hard type of wealth store of value, really. And as the politics and risk and volatility continues to happen, Bitcoin does seem like a safe haven asset that is backed by the electrons that digital miners actually use to create new Bitcoin.
Where do you see Bitcoin prices heading to the end of the year?
I wish I had a crystal ball, but I would be very conservative in saying at least 100,000, likely to the 150 to up to 200,000 per coin itself. Scarcity has actually doubled since last week, where the halving went from 6.25 BTC created every 10 minutes to 3.125. So although the transaction fees are supportive of the digital mining ecosystem, the actual true commodity being created has, unlike the US dollar or other currencies that are continually printed, decreased in issuance. And so because of that, more ETFs are actually being launched globally. The price should have a very good backstop with the demand for the underlying commodity itself.
So, Taras, so you see us moving to at least 100,000. What would be the downside risk to the call, Taras?
The downside risk could be, large-scale liquidations from some of the previous bankruptcies, or call it the Silk Roads of the world. We do know that some of the FTX coins have been moving around, and from my understanding, actually the Silk Road BTC that was taken from the insolvency committee has actually started to be distributed. So if there are people that need immediate liquidity, they could certainly be dumping into the market. However, the risk for large-scale investors to dump into the market probably won't happen for at least another year and a half, just because of how fresh some of those allocations are. That being said, with a globally dispersed ETF ecosystem, I think the volatility that we've seen in the past of anywhere from 10 to 40% in a day are probably behind us, which is a good thing because this is an investment asset that is really maturing.
And Taras, you say there will be a surge in M&A activity within the mining sector throughout this year and next year. Why do you see that M&A uptick, and what names specifically do you think could potentially merge?
Yeah, so we've actually seen some M&A already. We've seen some M&A with Hut 8, USBTC, a Canadian company merging in with the US operator. Marathon and CleanSpark have been very aggressive in some of their asset purchasing. Unfortunately, there's still some public companies out there that look like they could be acquired or rolled into a larger operation. Folks like Mawson, Applied Digital, Stronghold, they're all been under significant stress and pressure. Argo as well could potentially be an M&A target, or even like a company that's used for reverse takeovers for access to the public markets. The reason this is happening is because, again, this sector really is maturing. And what maturation provides to typical industries is consolidation of the number of players. We're going to go from 20 to 30 public market companies to maybe 10, 15 higher quality at scale companies. And we're actually seeing this in the services sector that supports these large data center operators as well, because they'd rather work with a large at scale service provider for their needs, which are approaching a gigawatt of power utilization, than small mom and pop shops that are 10, 15 employees. And so that's something that my company, Sunnyside Digital, is actually working on quite actively right now, is trying to consolidate the services and support space as well for the large data center operators.
Taraz, thank you so much for joining the show today. Really appreciate your time.
Thanks for the invitation.
Time now for our call of the day. UBS Investment Bank's chief U.S. equity strategist, Jonathan Golub, has downgraded the big six tech stocks, slashing his ratings on Apple, Alphabet, Microsoft, Amazon, Meta, and Nvidia to neutral from overweight. Golub noting he sees the rest of the tech sector and other areas of the market as more opportunistic than the stock market's 2023 leaders. Yahoo Finance's very own Josh Schaefer joins us now with more. Josh.
Yeah, Josh. So one thing to make clear about this as we sort of get into it is John Golub is a broad equity strategist, right? So he's saying the big six tech stocks, basically referring to them like a sector, like we would talk about energy, or we would talk about tech, or we would talk about industrials. So he had that in an outperform rating and he moved it to neutral, essentially getting to what you just alluded at there, Josh, which is maybe there's just less upside in these names. And he makes a case that's been pretty common on Wall Street, realistically, when we think about what he's saying here. He's really just talking about a broadening out of the stock market rally, and the fact that the other 494 companies in this case, because he's using 6 companies instead of 7, instead of 5, essentially saying that earnings are going to grow more for the other 494 companies than they're going to grow for the big 6 tech stocks that he highlights. And really what we're talking about from that sense too is earnings growth. So what you're looking at here in purple is what we're expecting for the first quarter. You can see 42% for that big 6. But then it comes down, right? So you're moving down. In the other 2 sectors that you have on your right there, you have the rest of tech, and then you also have the S&P 500 X tech. You're moving up. Normally, when you're buying a stock, you want to see growth metrics going up, not down, right? So it's really just quarter over quarter comparisons, and considering that maybe this massive run we've seen in tech, this huge earnings growth, is going to slow down. Where am I going to see earnings growth at a faster clip? Probably outside of that part of the market.
Were there any other variables he was considering? I mean, like valuation, or was he saying the AI boom is going to go bust, or no? It was earnings.
See, that's the interesting. He's not calling that the AI boom is going to go bust or something like that, right? He specifically highlights in here that it really isn't a call on AI or really valuations. It's really just more so that rotation, and he's sort of looking for opportunity within that rotation, and where else do you go?
Yeah, and I feel like we've been hearing from more and more analysts and strategists about this broadening out of the market. I mean, I do have that question mark whether or not we can continue to see this AI insulation with a lot of these big tech names, especially if the Fed does keep rates higher for longer. I do think this push and pull means guidance is extra important this earnings season, and I think you already saw that with a company like Netflix. They reported Q2 revenue that disappointed, and that led to a drop in the stock. There were other variables as well, but guidance, I think, is going to be a big thing for investors.
And it gets to just the comps conversation, right, too, and how we get to year-over-year earnings growth. And it's comparing it to the growth that we saw the year prior. He points out in this note, when you think about it for tech, 2022 wasn't a good year, right? Tech companies didn't have good earnings growth in 2022. The stocks did terrible. So in 23, they flipped the script, but now you have massive comps. And the further you get into this year, you're looking at just a significant amount of earnings that you then have to compare yourself to. And from a growth perspective, that gets harder for these companies. I mean, we have Meta coming up later this week. They're supposed to grow earnings by almost 100%.
That's crazy.
It's a pretty high bar.
Yeah, and Josh, just quickly, I mean, so he put out this note, but it doesn't sound like he's still constructive, Golub, right, on the broader market, it sounds like.
5,400 call on the S&P 500.
He didn't change that target.
He did not, and he said specifically because the reason he thinks those other stocks are going to work, right, is the economic backdrop. He thinks that story is still well intact, the economy is going to do well, and that's when your 494 start to pick up, and hopefully you see earnings pick up there, and then that's where you sort of get that rotation.
All right, Joshua, thank you. We move on. The United Auto Workers Union landing a big win in Tennessee. Volkswagen workers voting overwhelmingly in favor of joining the UAW. Historic win for the union as it looks to expand and organize outside Detroit. Joining us now to discuss is Autoblog editor-in-chief Greg Migliore. Greg, it is always good to have you on the show. So it sounds like UAW here, Greg. They make history. First, I think, organizing victory at a southern plant. Is this kind of one and done, Greg, or no? You think could it be the start of a bigger, broader trend?
Hey guys, thanks for having me. Always good to be here. The UAW's victory in Chattanooga, I think, is a watershed moment for the modern labor movement. It's the first time the union has organized a factory in the American South that didn't originally belong to one of the Detroit Three. And this opens up a whole new market of potential union members. There's factories that belong to Hyundai, Kia, Mercedes, Nissan, plenty of others. The Mercedes-Benz factory has a vote scheduled for May 13th. So I think, we're going to see a lot of what happens next year as to, how close that vote might be. And I think the success at the VW factory in Chattanooga, they had 73% of the workers approved it, taps into a broader mood of just positive feelings for unions across the country right now.
Greg, you mentioned that Mercedes plant vote, which is scheduled for mid-May, but that is expected to be a tougher fight. Do you think the UAW will be successful there?
Well, it's hard to look into my crystal ball, but right now I would not bet against them. I think had the Chattanooga vote been a little bit closer, maybe like, 55-45 or something, maybe you start to wonder. But 73% is an impressive figure. That's actually higher than some of the ratification rates at individual UAW plants among the Detroit Three automakers for the deal that went through last fall. So right now, I think the UAW has an excellent chance at organizing the Mercedes factory in Alabama. And I think for Mercedes and Volkswagen as well, it's important to remember these are German companies that are very familiar with the management and labor model. They have strong industrial unions in their home country of Germany. So I don't think they're going to actively fight this, perhaps as like maybe a Tesla or somebody might. I think they're used to having a collaborative relationship with the union. So I think there's a good chance of success in Alabama.
Greg, I want to also switch gears to another big trend, big topic. We have Tesla earnings on deck. Beyond Tesla, Greg, I just want your thoughts on kind of the EV slowdown we're seeing, Greg. I'm interested, how long you think that continues and what would we need to see to kind of re-accelerate growth for the industry?
Well, I think we're seeing a broader softening in EVs just in general. There's a lot of competition out there. I think a lot of consumers, the early adopters, already have their EVs. So right now you're in that sort of that canyon between the early adopters and then that more broader mainstream adoption. I think right now it's probably going to be slow for the rest of the year. I think what you're going to see is it's not that EV sales are necessarily falling. They're just not growing as fast, perhaps, as they were in the previous year. Right now, market share is about 8% for pure electric vehicles. And I would expect it to hover around that for about the rest of the year. Maybe you'll get up to about 10%. But
All right, we're going to be fixing the audio issues there, but Greg Migliore, thank you so much for joining us. Hopefully we'll get you back up and running there. Coming up, a possible U.S. TikTok ban is one step closer to becoming a reality. We'll break down the latest when we return. Time now for the day's trending tickers as we approach the end of the trading day. Verizon shares, they're slumping after the telecom giant reported a miss on the top line. In addition to slowing internet signups, shares are down about 4.5% right now. And Josh, this is the first post-earnings drop since 2022. And it's interesting because we saw a bit of a mixed report digging through the numbers. I mentioned that miss on the top line, but adjusted earnings did beat at $1.15 a share. That's compared to the expected $1.12. The company also reaffirmed its full year guidance, along with fewer subscriber losses for its wireless business. So overall, better than feared numbers here. But again, that revenue miss, plus, as I mentioned, internet signups slowing down. We do have a price hike that came in late March, which should provide an added lift to wireless service growth this year. But interesting to see the reaction in shares
Yeah,
today.
it was up, now down. Craig Moffett from Moffett-Nathanson, he's a smart guy. He out with a note to his clients. Good news, he told them, by 2025, Craig is estimating per share free cash flow will be above $5. A juicy, his words, Allie, not mine, 12% plus yield. The bad news, though, over the next 5 years, he says we project revenue growth to be something close to zero in nominal terms and well below zero adjusted for inflation. So no surprise. Good news, bad news. Craig winds up in the neutral column, which, by the way, is where most of the street is at. They're on the sidelines.
Yeah, it seems like the revenue issue, that's an industry-wide challenge. But, Verizon, they have that higher income consumer compared to some of those other competitors. So we'll see how they fare moving forward.
And moving on, take a look at shares of Informatica and Salesforce. Informatica announcing it's not actually in any talks to be acquired. That's after reports, remember, earlier this month that Salesforce was eyeing a deal to buy the company. So Mark Benioff apparently not, in fact, writing a big check, Allie. Remember, we did see those reports. Salesforce might be kicking the tires, getting ready to make a play for Informatica. And the point would be to kind of add CRM's data integration and kind of management capabilities. But now Informatica is saying, nope, not in fact engaged in takeover talks. And Bloomberg, citing a source familiar, says takeover talks cooled because both parties just had a tough time struggling to agree to terms. And then the problem seemed to be price.
And shares of Salesforce, they're up over 1% right now. Remember, activist investors in 2022, they were pressuring Salesforce to improve their margins. They really did not want them to acquire any other companies. And then we saw in early 2023 that Salesforce, they disbanded a panel to explore M&A activity. So sort of implying at the time that they wanted to avoid some deals, at least for now. Now, if this went through, it would have ranked among the largest ever by Salesforce.
Second, only to Slack.
Second, yeah, the Slack acquisition, that was $27 billion. So that would have been a pretty big deal if it did go through. And you wonder with the M&A activity moving forward, rates high, if now was the right time for something like this. Yeah. But I'm curious if some M&A activity will pick up throughout the year.
Yeah, it's interesting. I mean, there were investors who had questions when that headline crossed. I know there was strategists and analysts as well who had strategies. They were kind of just wondering why Benioff would want to buy Informatica, why not just partner instead. And so, anyway, it sounds like the deal is off, but who knows? Benioff, big checkbook. He could go hunting again.
Exactly. They have the cash. All right, moving on to our third trending ticker today. That is Disney. Aaron LaBerge, he's president and chief technology officer of Disney Entertainment and ESPN, but he will be stepping down from his position in June after more than 20 years at the company. He'll be joining sports betting operator Penn Entertainment as its chief technology officer, where he will continue to work with Disney on ESPN Bet, which is its licensed online sportsbook. So he's leaving for personal reasons. He's still going to be in the Disney family, or extended family, I should say, with Penn, but he was a key figure in leading a lot of the streaming initiatives. We have that integration between Disney Plus and Hulu, also bringing ads to Disney Plus. So he's been a key leader there, and he's yet another longtime veteran of Disney who we've now seen exit the company. Some other veterans include Kevin Mayer, Tom Staggs, of course, Bob Chapek, who was ousted from that CEO position, Bob Iger taking over there. But just interesting to see some of the executive moves at Disney right now.
Any movement on the succession story at Disney? Do we have any insight?
I've been speaking to a few experts and analysts. They don't anticipate anything until either the end of this year or next year. When it comes to any idea of where we could potentially be heading, Bob Iger's contract expires at the end of 2026. So we have a bit of time, and we do know that the Disney board is very committed to finding a viable successor. That was a big sticking point when we think about the proxy battles. Nelson
Do you ever
Peltz.
hear, Allie, when you talk to them, do you you ever hear, anyone ever float names to you?
Yeah.
Or at least who they're looking for, the kinds of...
I think the internal heads at Disney, so Alan Bergman, Dana Walden, Josh DeMauro, Jimmy Pitaro, those are the names that are being floated. And you would have to think that they're all going through a rigorous process right now. And I think more likely than not, it's going to be someone internal. And moving on, a possible TikTok ban is one step closer to becoming law. A bill forcing the divestiture of the social media app heads to the Senate after the House passed it this past weekend. The bill's advancement comes as China steps up its campaign against foreign social media services. To discuss the rising tensions between China and the U.S., we're joined by Brian McCarthy, Macron's chief strategist and managing principal. Brian, thanks so much for joining us today. In the event that the U.S. forces TikTok to divest, how do you think that will be received in China?
Well, it's already not being received very well by the Chinese. And I think if ultimately that push does come to shove, I would anticipate the Chinese government would pull the app rather than selling it. I don't think there's any way that they would sort of provide, tacit agreement with what the U.S. is arguing here. They will just deny that there's any, link between the Chinese Communist Party and the data that's being generated by this app. But this is a very long road ahead of us. The House attached the legislation to the foreign aid bill over the weekend, so the Senate was sort of trying to slow walk it, but it looks like they're going to be forced to vote on it this week, and it'll likely be signed into law by the end of the week. And then we're going to go to litigation. So TikTok has said clearly that they're going to fight this in court. They've already won a couple cases in Illinois and Montana. First Amendment versus national security, this will be a really big case, but will probably be pushed out into 2025.
But Brian, I guess help me think through something. If there is no actual relationship between ByteDance and the Chinese Communist Party, right, if that isn't true, then why would the Chinese not allow a divestiture and a sale?
Well, there is, but the fact that there is no connection is their story, and they're sticking to it come hell or high water. And I think while ByteDance is probably worth anywhere between $250 to $300 billion, there is a fair amount of capital at risk here. Now, the company wouldn't cease to exist if it gets booted from the U.S. market, but obviously that there's going to be tens of billions, if not triple-digit billions, lost. Much of it on the part of Chinese investors. But that's really small change compared to what China is fighting for, which is its unfettered access to our market. And this is just one of a number of fronts in what is an increasingly sort of heated debate about China's involvement in global marketplaces.
And Brian, outside of TikTok, Biden is looking to triple tariffs on Chinese steel and aluminum. What impact do you think that could have on U.S.-China relations?
That's sort of more noise than substance, frankly. Since Trump tariffed steel and aluminum, we're not really importing much at all directly from China. So raising those tariffs is really more a political message than anything substantial. Now, no one knows how much Chinese steel we're buying indirectly through Mexico and other places. They're not really talking about cracking down on that, which is probably, the crux of the problem. So we're just getting a lot of noise here into the election. And frankly, some of this stuff we've been debating for years, if not a decade or more. And in terms of, other than the Trump tariffs, there's really not been a lot of practical pushback against China's overcapacity and its domination of a number of industries. So the talk is really getting louder. It's becoming shouting as we head into the elections. But it's still not entirely clear to me that politicians in either the U.S. or Europe are really ready to stand up and do something about what is going to be an increasing flood of Chinese exports and, our imports, because the Chinese economy is flat on its back. It's really the only lever they have to maintain growth in their economy is to export. So this is an issue that's really going to heat up into the election. But again, in terms of substantive actions, it's still a lot more talk than action, frankly.
Brian, I'm interested with this election coming up. When it comes to their just the kind of approach to their general approach to China, Brian. What are the big differences at this point, in your opinion, between Biden and Trump? Because it does seem both at this point are pretty tough on China.
Again, they're both tough in terms of words. Now, substance, Trump was tough for a while. He raised a bunch of tariffs, but in the end, he caved, basically. So, 2019, we're heading into election, and Trump, made an agreement to take the pressure off China, to sort of at least temporarily give up on forcing China to make fundamental structural changes to their economic system in exchange for basically China buying a bunch of soybeans and other stuff. Subsequently, China didn't buy those soybeans and other stuff, and the Biden administration never really followed up. So, Trump talks a big game, but whether he's really up to that task, I don't know, because the bottom line, crux of the problem is actually taking steps to decouple from China is insanely expensive at this point. And whether we can actually take substantive steps to decouple without causing a recession in the West is unclear. So these are very, very difficult choices that our system has struggled to make, frankly. So again, the talk will reach a crescendo in coming months. We're hearing it from Europe. Europe is talking about tariffing Chinese EVs, which are pouring into Europe. But on the other hand, the Chancellor of Germany was in China last week saying nice things. So, there are constituencies on both sides of this issue. Again, to me, it's an open question whether either the U.S. or Europe will take substantive steps to crack down on these imports.
Brian, thank you so much for joining the show today, helping us walk through a big, complex subject. Appreciate it.
Thanks for having me.
And coming up, some of the biggest tech names on the street set to report this week. Which company is best positioned? We'll discuss that in our Investor Playbook. Several of the biggest tech names on Wall Street are slated to report earnings this week. Investors are hoping solid results from the likes of Meta, Microsoft, and Alphabet will reignite market enthusiasm. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. We're joined now by Dan Morgan, Synovus Trust Senior Portfolio Manager, and Ben Beharin, CEO and Principal Analyst of Creative Strategies. Guys, it is good to have you both on the show. And Ben, I'll start with you. Maybe kind of an unfair question, Ben, but tech earnings. And obviously we talk about tech. It's a lot of verticals, a lot of subsectors. It's online advertising and semis and cybersecurity, Ben. But give me your general take on this tech earnings season, Ben. Is it going to be positive for tech investors? Do you see it as a catalyst?
Yeah, I think if you just look at quarters past, one of the big questions that we've all wrestled with is who's getting the most beneficiary lift from AI stocks, and then my bigger concern has been do we have outsized expectations of AI growth? So there's been some instances where companies have actually had fairly good growth, and then on top of that had a little bit more volatility on their stock because, again, their expectations for those earnings or for a particular business unit's revenues was just higher than was what was realistic. And so for me, looking into this, I think we're going to have some strong quarters, particularly on the back of cloud growth, compute, the AI infrastructure that we're in, particularly around Microsoft and Google. But I'm not sure that necessarily translates into the predictable things we've seen before, just because I'm worried about the bubble-ish cycle of AI and really where those valuations should be, and some volatility relative to these stocks as well that we haven't quite seen before prior to this AI bubble.
And Dan, I want to get your thoughts on that as well. Do you think that AI will be able to continue to insulate big tech from higher rates and some of these other market risks?
You know, it's Ali, if we strip away the whole AI picture and just kind of gum into these upcoming reports that we have, I mean, the percentage of revenues that, for example, let's say a Microsoft is expected to get next year from AI is about 5 to 7%. It's not a huge number. So if you kind of go back to these businesses in terms of their core, how they've gotten to where they are today, we're looking at very strong growth. We had a couple of muted quarters about 4 or 5 quarters ago, but like you're heading into Meta, they're expected to grow at a rate of about 25% year over year in earnings on this quarter. You look at Microsoft is going to grow around 15, and you're looking at Alphabet at about 13. So we keep talking about AI, and yeah, it has a big impact on, let's say, Netflix and Nvidia and AMD in terms of we can actually see huge amounts of profits coming down. But these 3 companies we're going to talk about today in terms of earnings, we're not going to have a huge AI effect in terms of like 30% growth coming from AI, but their core businesses are very strong.
Ben, sticking with the AI, these big tech names that are going to report, Ben, have put a lot of money and time and effort into this tech. And I'm just curious, Ben, when you look at, let's say, Microsoft or Amazon, Alphabet, are some of those names, Ben, are they showing perhaps greater traction than others in this story?
Yeah, I mean, I think, again, you just look at the hyperscalers. Obviously, Amazon has been a huge cloud provider. I think they're the one in market share in terms of overall cloud instances. Microsoft's there second. I think they've got a little bit of an edge on the AI story. The hard part about this is we don't entirely know all of the ROI yet for the industry and how expensive it is to run, deploy, and put software on a host of their innovations around AI, and obviously they're all spending a lot on silicon from Nvidia. They're doing their own custom silicon. These are expensive, so we want to see how that's monetized. But there's obviously a huge rush here in terms of cloud growth, which I think you'll see from all of those names. But like I said, I keep coming back to, are we in a cycle where some names were more valued or more of that speculative growth was priced in, and now we're seeing some rebalance of that, and how people react to the growth that, again, I agree with Dan, I think we'll see, is where I'm just not sure, just because every investor conversation we have at the moment is still very focused on how big is AI, what share will they have, and how big is this growth rate and this overall TAM expansion coming to the industry because of AI.
So given the focus on AI, Dan, let's say the Fed does not cut rates this year. Do you think that has any impact on any of these tech names at this point?
Well, it's interesting, Ali, because we had a big run up in tech. You look at Netflix last week, and then they've kind of leveled off. And a lot of that's been due to what has happened in regards to, the recent inflation data that we got in terms of core CPI and kind of the expectations for the Fed funds rate. I think at the beginning of the year, we're at 3 to 4 decreases. Now those expectations have maybe gone to 1 to 2. And we know, Josh and Ali, that the tech sector traded in unison with the Fed on the downside when rates were going up. So by extending this period of time until we supposedly get a rate cut, I think that's actually kind of had these companies roll over a little bit. But with that being said, Josh and Ali, if we look at the growth that's coming out of tech right now, going in this first quarter, I mean, S&P consensus is 20% growth year over year. We're looking for 70% growth year over year out of the chip sector. So they're delivering growth regardless of what the Fed is doing, even though they've got rates at 5.25, 5.5.
And Ben, I want to get your take on Apple as well. Listen, they're not reporting this week, but they are on deck. And there's a stock, Ben, that's been under pressure. It's down about 13% so far this year. It's concerns about the company's AI strategy. It's the China business. It's the regulatory scrutiny. I'm curious, Ben, when they report, what do you expect to hear from Tim Cook's company?
Yeah, I mean, I think they're going to address some of the softness in the market that's definitely happening. I mean, obviously, a big question around what can we expect in terms of refresh rates. The smartphone cycle, the PC cycle, the device cycle as a whole has been elongated. Their point about what they could do in AI, and this is true of a lot of companies that see stalling hardware sales, is just whether or not that strategy, whatever it is going to lead to any increase in sales or start to pick up the refresh cycle. I'm still skeptical that that's the case until we see it. But I think right now, I think there's a hope that they'll at least be flat to moderately up year over year. And the June quarter, I think, has become a bit more of a question now leading into the second half of the year. But clearly, sort of the main point is there is softness. That softness is hitting them. That's being priced into their stock. And so the extent of that, I think, is what we'll wait to see when they post earnings and with the on-call commentary.
And Dan, we talk a lot about the Magnificent Seven, but are there opportunities within tech outside of those names that investors should be exploring?
Ali, we've actually seen strength really spreading throughout tech. It's not just been those big names that everybody knows. I mean, you look across the board, I talked earlier about chips in terms of expected growth on this upcoming quarter. We've had good strength in that group. We are seeing some strength in enterprise software, not as much as we would hope. But it's definitely been spread out much more than it was, let's say, a year ago when we had the big move up and it was all Nvidia and all the big names and then everybody else was kind of left behind. I have noticed that within the tech sector, it is spreading out to these other groups. So I think there's still a lot of good opportunity in tech, going into this quarter and going into the remainder of the year, regardless of what the Fed does.
Dan, Ben, thank you guys both so much for joining the show today. Appreciate it.
Happy to be here.
Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime. That is the closing bell on Wall Street, and now it is market domination over time. Let's get you up to speed on the action from today's trade, sponsored by Tasty Trade. You can see, look at that. We're going to end the day in the green here. We did lose some steam into the close, but it looks a lot different than last week. Remember, last week we started every day in the green, then we would just kind of fade into the close. Not today. It looks like the Dow's going to end up about 0.7%. It's going to tack on about 254 points. Let's check out the tech-heavy Nasdaq. That's going to tack down about 1%. Finally, SPX, the SP 500, your broad gauge, that is going to end the day up about, call it 0.9%. Of course, investors got a busy week ahead. We got big earnings, including those mega cap tech earnings. What do they say about the quarter? What do they say about the guide? Is it enough to lift consensus estimates? Because that, of course, is what could lift the market higher. And remember, key economic data as well this week. We got the GDP on Thursday, and of course, PCE, that's Jay Powell's preferred inflation gauge. That is on Friday, Allie.
Yeah, thanks, Josh. And we're now joined by markets reporter Josh Schaefer with today's takeaways from the trading day. So, Josh, we had the SP 500 snapping that 6-day losing streak. Where do you see things going now from here?
Our other Josh, the better Josh, right? Josh Lipton, I think, really hit the nail on the head just talking about the market action and the fact that we actually stayed higher today. This is something that we've been watching over the past week, essentially looking at something like a 5-day chart, and you can see here we have been going up and then you fall at the end of the day, up and then you fall at the end of the day. So I think just seeing a little bit of resilience in this market, knowing that essentially maybe we have some level of stability at the current levels that we're at, is probably a positive for investors, I think. And then I think, guys, just thinking about sort of where the action was today, it stuck out to me to see several sectors up. It's not like we just saw a big tech rally. Like, yes, Nvidia I'm looking at was up over 4%. But when you look broadly across the S&P 500, I'm looking at the Wi-Fi Interactive right now, you have 4 sectors that were above that outperformed the S&P 500. Yes, you have tech, but you also have utilities, you have consumer staples, and you have financials. So it's a little bit of that story we've been talking about over the last 2 months now of some level of a broadening out and maybe it not all being tech. And it's interesting to me, I think, to see that that's where buyers came back in here. It's not just the big tech names that we talked a lot about on Friday when the Nasdaq fell, but people still wanting to get into the other trade outside of tech.
Yeah, what's your sense of what big tech, Josh? I mean, you think they can just report and beat and that's enough, or no, they're going to have to really give you a bullish guidance?
Isn't that what they always do?
I'm kidding. I think that's
well,
Netflix. You got to pretend like they don't, Josh. Otherwise, it doesn't have any drama to it.
That's been the Zuck story for the last year, right? But I think it'll be interesting, Josh. Specifically, I'm curious what Microsoft says about AI and how it's contributing to revenue right now or in the next quarter or two. I know from covering the company's earnings releases the past couple quarters, it's been a little bit of, okay, we're bullish on AI overall. Investors are happy about where Microsoft is in the AI space. But is any of that money coming back into the company right now? And thus far, the answer has been no. And I think it'll be interesting to see if that can maybe sway sentiment. Because I do think that's a large part of the story at the end of the week is what do we learn about the AI narrative overall? Where are we? Are we investing more in that? Is the investment more going to help a company like Nvidia where they're buying chips from? Is it going to help other companies outside of them? I think that's sort of the broad read through when it comes to that.
And expectations are so high, right? I mean, Netflix was a tech company. We saw a report last week, and they saw their stock fell because they didn't beat and raise. And I think that was an expectation. So you wonder with some of these tech names what could happen there. But you're also watching Tesla. And
where expectations are not high.
I mean, exactly.
Expectations are not high at this point. And I think this will be an interesting one to watch for me going into Tesla reports earnings after the bell on Tuesday because expectations aren't high. Like, we're finally at a place, I think, with Tesla where maybe the expectations are starting to become a little bit more realistic. And you wonder if Elon can say something on the call that actually reinvigorates some confidence in this company.
Well,
it feels like we just haven't had a positive headline on Tesla in a month.
You would want, I think if you were a Tesla investor, you'd wait for the call and you would hope Elon Musk would just give a lot more details about the smaller car on the way or what exactly is going to happen at this big robo-taxi event over the summer. But whether you're going to get that, I have no idea.
No, I mean, that's been that's kind of how the stock has moved in the past, right? Is a little bit on some of the pie in the sky ideas. The things that aren't actually coming next quarter are going to contribute to earnings this year, but some great idea like a Cybertruck that might come, 5 years after they actually announce it. And I think that, but that little tidbit and maybe clarity on that low-cost car or just margins and where we're going to get with that margin story. Have we fully bottomed? Is that coming back? There's a lot of questions going into the call, and it will be interesting to see in this environment for a stock that's down over 40% this year, is there more pain ahead, or are we finally seeing perhaps maybe enough coming out of that stock for the rebound?
Yeah, I know, the
A lot
pricing
of tension
wars
on the
too.
call. Yeah, for sure.
We'll be listening. For sure. Me and you, Josh. We'll be listening.
Thank you, Josh. Moving on, the Fed dialing back expectations of rate cuts in 2024 as Powell points towards rates staying higher for longer. The Fed's messaging painting a complicated picture for regional banks this year. For more on this, let's bring in Randy Payne, president of Key Institutional Bank. Randy, it is good to see you. I wanted to start off here, Randy, because I heard your CEO talking, Randy. I was interested. He was saying that you guys are ready to play offense. I think that's how he put it. What did that mean, Randy, playing offense?
He did say that. He said that last week on our earnings call. And it's really about just the transition from last year. Obviously, the entire industry went through a period of stress, but we really saw things normalize over the course of the second half of the year. And now Key specifically, we've built a tremendous amount of capital, and it's about supporting our clients, growing our relationships.
Did that also mean, Randy, when you talked about that it also mean kind of emphasizing different businesses differently?
He did. He did mention certainly our investment banking business, our wealth management business being two of those areas. And in this new environment, Josh, where regional banks specifically are going to have to operate with less capital, when we can drive our revenues with fee-generating businesses, that's where you're going to see Key, and I think many of our peers invest, given the expected changes we see coming.
And Randy, I am curious what you are hearing from clients. Obviously, a lot of uncertainty out there. When you think about interest rates, there's now the possibility that we could receive no cut. Is that giving your clients anxiety? Is that something that they're really focused on, or are there other risks?
Yeah, it's a great question. It's a time of uncertainty for sure, but in general, when we talk to our clients, they say, well, my business is great. We're growing. Inflation is still high, but it's started to normalize. But they're concerned about what they see going on around them. So whether it's that inflation is still higher broadly, certainly what's happening overseas, the election coming up. So it's a dichotomy in that broadly, our customers feel good about how their businesses are positioned, but they're cautious about the overall environment.
And Randy, was that in part, no change, I don't think, to your guidance for net interest income for Q4?
Correct.
Why was that?
Really, we're operating under a period or a range of outcomes that even if there are no cuts or we get 3 or 4, we're going to hit our guide. And so that on the margin, it's going to determine whether or not we're at the upper end of that guide or in the middle of that guide. But we feel good about how we're positioned and our ability to meet that.
And I also want to get your thoughts on the IPO market, because it's been pretty dry, maybe some pockets of pickup. Do you think we could see public markets accelerate this year? Will we have to wait until 2025, or does it just ultimately depend what the Fed does?
Yeah. I think the Fed is going to be an important variable. And if we get no cuts, that I think will put some damper on what we expect to be a more normalized environment. We did start to see IPOs in the first quarter and even a broadening of the IPO market. For example, there was a large healthcare REIT that went public. We were a part of that as a lead underwriter. We hadn't seen a REIT go public since 2021. And so we do see, as we look at our pipeline, more IPOs coming, companies filing, updating their filings, and it's broad-based. It's not just tech. It's not just biopharma. It's broader. It's broader, and we saw that with the healthcare REIT transaction in the first quarter. So I don't think we're going to see a hockey stick, Allie, but we do expect more activity certainly this year than we've had the last 2 years.
What about M&A too, Randy? Because I think there was probably some expectation, some optimism there, and you've seen some, like the energy sector we've talked a lot about, but broadly, would you expect a pickup there as well?
Well, we had the most large cap M&A that we've had since the third quarter of 2021 here in the first quarter of this year. And that's, I think, a precursor to more M&A to come. And that's going to be driven by a few things. If we were sitting here a year ago at this time, even before the banking crisis, we would have been talking about a recession's coming, and we don't know if the rate cycle's over. Today, sitting here, we've got certainly consensus is that we're going to have a soft landing, and we might have 2 cuts, 1 cut, 3 cuts, but we all expect there to be cuts coming, and certainly not increases in rates. That's a very different psyche for companies and boardrooms as they think about M&A activity. And so we do see, and we saw this happening with our pitch activity starting in the fourth quarter of last year when consensus was that we were going to get a soft landing. And at the time, they were talking about 6, 7 rate cuts. I never bought into that. But still, from a psychological standpoint, which M&A is a lot about having confidence, you saw that start to turn. And then when you add to that, just the amount of capital that private equity has to deploy. At the end of 23, it was $950 billion. 10 years ago, it was 40% of that. And last year, private equity returned 11% of its NAV to its LPs. The median for the last decade has been 25%. So there's a lot of dry powder. LPs have not seen a return of capital. You have more clarity around the economic environment going forward. That is going to bring more M&A activity, and we've seen that at Key. We said last week on our earnings call that our M&A backlog was at record levels, and that was after our record first quarter investment banking fee print.
All right, Randy, thank you so much for joining us today.
Thanks for having me. Appreciate it.
Tesla shares tumbling again in the run-up to earnings. More on what's driving the latest declines is coming up next.
A quick recap on the action from today's trade, sponsored by Tasty Trade. Both the S&P 500 and the Nasdaq snapping their 6-day losing streaks during today's session. The Dow finishing the day more than 250 points higher, followed by the Nasdaq, which rose more than 1%. The S&P 500 ticked up about 0.9%. Meanwhile, Treasury yields rising slightly, with the 10-year note trading around 4.62%. Remember, 4.7% is that next technical level to watch. All sectors ending the day higher, with technology, utilities, and consumer staples leading those gains. Meanwhile, Tesla closed out its 7th straight trading day in the red, tied for its longest ever losing streak. The downturn comes as the EV maker is set to report earnings tomorrow after the bell.
All right. Moving on, Tesla stock down ahead of earnings. For more on what to expect from tomorrow's big report, we bring in Yahoo Finance's Praz from Meridian. Praz, what should we expect?
Yeah, so big picture stuff, right? Adjusted EPS, 52 cents a share. Top line revenue, 22.31 billion. All sounds nice, right? But that'd be the first revenue decline in 4 years for Tesla, quarter over quarter, and going to put 1.5 billion in operating profit. 40% slide from a year ago. So you're seeing some serious damage here potentially compared to how they're growing historically over the last year to 2 to 3, 4 years. Now we're seeing a little bit of a kind of drawback here. We already had that big miss in deliveries that we saw. Big difference between production and actually sales. So what's going on there with that buildup? Are we going to hear more about potentially EV demand issues? Is Musk going to say, you know, it's all about price. It's all about price. We got to get it cheaper. Then we'll sell everything. So maybe we'll hear more about that. Not sure, but we'll see. But then also the big picture is product roadmap. Is that Model 2, that smaller, cheaper EV, truly dead? Like Reuters has reported, and Musk said they were lying, but didn't actually address the fact, is it really dead or not? Instead, saying the robotaxi is going to come out we're going to see it on August 8th. Is it going to see a real car or a drawing? What's it going to have inside? Pedals, no pedals, steering wheel, no steering wheel? That's the kind of thing that I think people are asking about.
We were just talking to Josh Schaefer about this, though, Praz. If I was a Tesla investor, I mean, this stock has gotten rocked this year. I'd want some hard, concrete details about everything you just mentioned. I mean, do you think I get that tomorrow?
I don't think he will. I think if Musk truly, he doesn't seem to care about the stock price, but if he does, he might actually say, hey, you know what? They might show a drawing or a picture of the robotaxi in the shareholder deck tomorrow. Maybe we'll hear some.
I don't know. You think a drawing gets it done, like a watercolor print? That's
something. I mean, a design sketch, right? But if we hear that, and we also hear something about like, oh, that Model 2, can't talk about that. But we are working on a cheaper vehicle. Something like, just give them something.
Well, the Wall Street notes, right? In the Wall Street notes I've been reading, it seems like there's a risk that Musk is pivoting towards these robo-taxis rather than focusing on those more affordable, cheaper EV models. What have you been hearing from analysts and investors on the street when it comes to some of those potential risks, if that is the case, if there is a complete pivot to robo-taxis?
Most of them believe that the Model 2 is not going to happen. This cheaper car is on hold for whatever reason, and it changes the investor thesis of the stock. I keep doing this. Changes the investor thesis of the stock, and they think that it's going to be a turnover. One of them says it's going to be a turnover in shareholding class. It's going to be people who believed in the Model 2 are going to be kind of getting out, and people that are buying into the long-term AI, dojo, FSD, robotaxi, kind of big 10-year picture horizon stuff, they're going to be rolling in. If enough of them will come in, then it doesn't really matter, but it seems like there's not. One analyst, John Murphy of Bank of America, said that the Model 2 is not dead. He thinks that it's still part of the big picture, part of the thesis of the story. And Tesla had mentioned in Q4 that they were working on it, so he thinks that it's still happening. So there's a split, but most of them think it's not happening.
Well, we'll have a lot to watch. You're certainly going to be busy. Thank you, Praz, for joining us today. Sticking with Tesla, the company may be facing some new legal issues after asking shareholders to reinstate CEO Elon Musk's multi-billion-dollar pay package. Yahoo Finance's Alexis Keenan is here to help break it all down. So what does this all mean for stakeholders when you think about Tesla? Obviously, a lot of issues at this company right now.
Yeah, I think we've become used to big companies companies like Tesla being in a ton of litigation. But what I'm hearing from experts in corporate structuring and pay packages like this is that just expect more regardless of how this shareholder vote goes, should it make it to shareholders, right? There's still some steps. The SEC has to review these proxy materials that the company submitted. But once this whopping $56 billion pay package is voted on again, either way, they say shareholders will have a beef with that because the money, that $56 billion, which is now amounts to about $47 billion with the change of the stock price since the court's decision in Delaware, that money is either going to stay within Tesla, maybe good for Tesla, some shareholders think, or it goes to Musk. Some shareholders might think that that's the best thing, that he gets compensated. The company did say in these preliminary filings that Musk hasn't been paid in 6 years and we need to compensate him somehow. And what they want is 100% reinstatement of this pay package. Now, Tesla has tried in this statement to cure what ails the Delaware Chancery Court. They have said that they formed a special committee to evaluate this compensation, that they've had third-party analysis. They've also attached the court ruling to these materials. But look, that special committee is one person. It's coming from one independent board member's recommendation. And so the shareholders could say, no, that's not good enough. That approval is not enough, that these ties that the Delaware court had issues with between Musk and the board and Musk's influence, having too heavy a hand in the negotiations to get that pay package, they might say it's not good enough to come from this one director as a recommendation. They also might say that, look, there's inadequate peer review. That's a standard that happens in corporate America where the compensation committee goes out and tries to benchmark these proposals, what should be the executive pay, against others in the industry. On the other hand, maybe there is no Musk peer. Maybe there's no comparison that is going to be appropriate for him because he is a pioneer in his industry. So a lot to think about, but certainly more litigation and whether or not shareholders want to compensate him what is something like $9,000 per vehicle sold so far. More to come.
Good work if you can get it. Alexis, thank you. Appreciate it. Time now for what to watch Tuesday, April 22nd. Another big day in earnings, including Tesla, Visa, General Motors, Pepsi, Mattel, and Spotify. They are all reporting. All eyes, of course, going to be on Tesla tomorrow after the market close. Some analysts expecting the company to miss on earnings per share as EV growth continues to slow. And after Tesla's first quarter deliveries came in weaker than expected. General Motors, meanwhile, reporting tomorrow as well. That's before the bell. Analysts also expecting the EV drag to affect earnings for the automaker's first quarter. And also reporting, we're going to have GE Aerospace reporting for the first time since the company's spinoff. That's alongside UPS, Lockheed Martin, PulteGroup, and JetBlue.
And scrolling on over to TikTok, the Senate voting on whether to pass a bill that includes an avenue to ban TikTok in the United States. A number of senators have come out in favor of the proposal since being folded into a broader foreign aid package. If the bill passes, it would give ByteDance, TikTok's Chinese parent company, up to 360 days to divest TikTok or face a ban in the United States.
And finally, new home sales data for the month of March coming out in the morning. Economists expecting that number to go up, providing more insight into the housing market after seeing strong sales numbers from home builders' earnings so far this year.
And coming up on the other side of this break, we're chatting the latest housing hurdles as part of our week-long special, Real Estate, the New Reality. Stay tuned, more market domination overtime still to come.
U.S. home builders came into 2024 on the back of a banner year that was 2023. Low supply in the resale market, fueling higher demand for new homes. However, as mortgage rates climb and expectations shift now for interest rate cuts, where does that leave the rate-sensitive home building sector? Here to discuss as part of our week-long special, Real Estate, the New Reality, we have Jay McCanless, Wedbush Securities Equity Research Senior Vice President, joining us now. Jay, it is good to see you. So maybe we'll start there, Jay. You know, the market obviously is repricing, rethinking, Jay, the Fed's path to cuts. It wasn't so long ago, Jay, it was 6 cuts, and now increasingly we hear people coming on the show and saying no cuts. Larry Summers says maybe you should get ready for actually a hike. How does all this kind of impact and influence your coverage universe, Jay?
Well, thanks for having me on. I think what we've seen, we watched the 10-year rate, 10-year U.S. Treasury rate, and mortgage rates a little more closer than the Fed funds rate, and mortgage rates have been moving the wrong way. We're back above 7% now, solidly above 7%. That means the builders have to do more buy downs on mortgage rates and have to do some other things to try and keep these homes affordable. So yeah, the rate environment has gone from being pretty benign at the beginning of the year to being much more negative now than we would have expected, and that's why we're generally kind of neutral to bearish on the group at this point. Not because of lack of demand, it's just what's going on with the rate environment.
And you mentioned Treasuries, the 10-year yield is above 4.5%. What risk does that have on the housing market?
So I think for the housing market, you know, certainly, or not certainly, but typically will make mortgage rates stay high, stay at levels that just from an affordability standpoint, a lot of people can't make. We also think in certain parts of our other coverage, multifamily and in mortgage, the refinancing costs for some of these multifamily projects are going to go up. And I think that's a larger risk for some of the names we cover, is that being able to refinance some projects right now may not be as possible as it was earlier this year when the 10-year was below 4.5.
I'm interested, Jay, you know, on the other hand, we've had some of your colleagues, other financial analysts who cover these names, Jay, they come on and say, you know, investors should know that these home builders, it's a different kind of company than it used to be. They're more efficient than they used to be. You agree with that? Do the business models look different now?
I fully agree. They're from the group is carrying less debt than it was 5 years ago, and especially 10 years ago. They are building the homes certainly more efficiently than they were back then. But at the same time, it comes down to monthly payment, and the builders, I think, have done a good job of trying to shrink the size of the homes that they're building, reduce the amenities that they're putting, especially in some of the starter homes. But at the end of the day, if the mortgage rate's gone up, 100 and something basis points like it has this year already, that's just going to reduce the size of the population that can potentially buy a home. I think the builders also, are looking at ways to bring those, again, to bring the square footages down and find other ways to make these homes more affordable, doing attached product and some things like that. So, yeah, I think these are better run companies and generally better balance sheets than they were a few years ago. But at the end of the day, it's can the buyer make that monthly payment? And I think it's becoming increasingly difficult for some of these builders to make that happen.
And Jay, what do you expect when it comes to demand? Do you think demand will continue to stay high, or do you think buyers are waiting to potentially see mortgage rates come down? Do you think they just want to get into the market as soon as possible? What are your thoughts on the future demand outlook?
Yeah, so from a demand standpoint, we feel like the demand is going to be pretty solid for a few years, because you have the millennials, which are a fairly large population group in prime household formation years. The Gen Zs are right behind them, also starting to get into home ownership. So feel like the demand side of this is a really good outlook for the builders and going forward. But again, with rates having moved up and now with prices starting to accelerate again, we've seen home prices appreciate mid-single digits for most of this year. It's kind of both those things are working against those buyers. But yeah, with the need for housing is probably as high as I've seen it in my years of covering this group. So once we can get some rates and or maybe some home prices to come down a little bit in terms of what the builders are offering to consumers, then that'll help solve for that affordability challenge.
Any builders in your coverage universe, Jay, you still have a buy on here?
Yeah, we have on the manufactured housing side, we have a buy rating on Cavco Industries. They're a manufactured housing producer, national manufactured housing producer. We like that name from an affordability standpoint. We also like a small cap name, LSEA, LSEA is the ticker on that one, and we're outperform rated on that one. They're mostly coastal California, as well as down into Texas and Florida builders. So those are two names we like on the long side.
All right, Jay McCanless, thank you so much for your insights. We really appreciate it.
Thank you.
Coming up, Meta CEO Mark Zuckerberg shares major news about the future of virtual reality. More on the other side of this break. Mark Zuckerberg posting again on Instagram today, this time to talk about Meta Horizon OS. Here's some of what he had to say.
We've been building Meta Horizon OS for about a decade. We started building it off Android, and while it's still compatible, we've now built it into a much broader and more capable mixed reality and spatial computing OS.
For more on the new Meta operating system, we're bringing in Yahoo Finance's Dan Howley. Howley, what does this mean for the VR headset space moving forward?
Yeah, Ali, it's really interesting. This is kind of a way of them ensuring that other manufacturers will also be building headsets and making sure that there's more software options available. So let's just back up and go over what an open model and a closed model is. Open model is, think of your PC. Any manufacturer can build a Windows PC as long as they get the Windows license, and then you're able to download whatever you want, run whatever software you want on your PC. A closed model would be something like your iPhone, where no one else can run iOS except for Apple, and the only apps you can download are available through the App Store and Apple itself. Android is open, but it's annoying to be able to get apps on there that you have to go through warnings and whatever. But what Meta is doing here is opening up its Meta Horizons OS. It's the OS that runs its Quest 3, Quest 2 headsets, and ensuring that anyone would be able to build apps for it, and that it would be on other hardware. So some of the other hardware manufacturers that Zuckerberg mentioned were the likes of ASUS, Lenovo, and Microsoft. And he says part of this would allow for specific types of headsets to be developed. So one thing he mentions is a headset that would be lightweight, that connects to your computer, that you would be able to use for productivity. Another would be one that's also lightweight and sweat wicking, so you would be able to use it for working out. A third would be something that comes with an Xbox controller, and then you can connect to Microsoft's Game Pass and then be able to just play games directly from there. So it really is a kind of interesting move here. Seems to be a way for them to move this forward.
And Dan, switch gears, we also saw some more moves in the gaming industry. What can you tell us about that?
Yeah, Embracer Group, they're a large gaming company that when interest rates were very low, were snatching up studios left and right. And they had purchased Gearbox Games, and then they're selling Gearbox Games, the maker of the Borderlands franchise. And so now what they're doing is revamping the entire corporate structure, splitting into three companies, really. One is going to be dedicated towards building Lord of the Rings, PC, Tomb Raider kind of games. Another would be for free-to-play games, things like that. Another would be for tabletop games. And it really kind of points to the struggles that the gaming industry has been going through with the higher interest rates and with some slowdowns as far as game development goes. This is developing games is a very long, arduous process, and a lot of times there are slowdowns. And when it comes to corporations, they end up taking that and saying, "Look, now we're going to be losing money on this." And so, Embracer breaking up into three different groups, so they say they'll be able to handle things a little better.
Dan Howley, thank you, my friend. Appreciate it. And that's going to do it for today's Yahoo Finance. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. And coming up, an encore showing of our latest edition of Next. We're taking to the skies for a look at the future of electric air taxis. That's next on Yahoo Finance.
Marina traffic, experimental 542, Bravo Juliet.
So we're at the downtown Manhattan heliport, and what we're going to do is we're going to take off.
Yeah.
All I want you to do is pull back with your right hand. That will make you go up. Just pull back hard. Yep, and there you go. Now you're flying.
I'm flying.
We're not actually flying above the Statue of Liberty. That's a simulator from Joby Aviation, which is used to train traditional pilots on how to fly this battery-powered aircraft. With the backing of Toyota and Delta, it's one of the largest companies looking to bring battery-powered air taxis to market. These aircraft are called eVTOLs, which stands for Electric Vertical Takeoff and Landing. At first glance, it may look like a helicopter with extra propellers on top, but unlike choppers, eVTOLs run off electricity rather than fuel.
This is for charging.
It took us about 6 minutes to get from JFK to downtown Manhattan.
Over $22 billion in investments over the last 20 years from names like Uber, Stellantis, and Honeywell have now made this kind of a commute closer than ever, thanks to advancements in eVTOL technology.
High-performance propeller blades that are very light.
In addition to Delta, major aerospace names like United and Boeing see the potential and have invested with the hopes of one day adding eVTOL rides to their list of offerings. Getting in now makes sense. One research firm estimates the air taxi market could be worth more than $65 billion by 2028. While the tech has proven to work, and it could be even closer to commercial launch in Europe, here in the US, regulation, lack of infrastructure, and customer affordability could be what keeps these companies from taking off. Yahoo Finance went inside Joby's 130,000 square foot assembly facility to learn more about how the company hopes their aircraft and their business strategy will win the air taxi race. This is what's next in the business of electric air taxis. Flying above traffic in a congested city sounds like fiction from the Jetsons. But air taxi companies believe they can make this a reality as soon as 2025.
This is as close as we've seen, I think, in terms of the technology coming together to make something that you could use on a daily basis to go where you want to go and do the things that you want to do, which is kind of what a car is all about, I think. That is something that's going to be practical and available to people in the pretty near term.
The Joby aircraft has completed more than 1,000 test flights. The aircraft can fly 5 people, including the pilot, up to 150 miles.
What can you do with the way you design and build an aircraft if you have a world-class electric propulsion system available, which no other aircraft have really been designed around in some ways?
The 6 motors on the aircraft are powered by 4 batteries, which were developed by a team of ex-Tesla employees.
What that lets you do is fly very, very efficiently, which makes all electric work.
And makes all electric safer, too. Redundancy was built into the aircraft. Everything has backups in place.
So this is a battery, this is a battery. Does that exist on the other side, too?
Correct. So the aircraft has got 4 batteries. You've got that redundancy. You can afford to, we can lose a battery and we still fly perfectly fine.
Electric aircraft face similar challenges to electric vehicles, which don't have the added hurdle of launching into the sky. Among those challenges, battery charging times. Joby can go up to 100 miles on a single charge, meaning it could do 2 trips back and forth to JFK from NYC's downtown heliport before needing a recharge. Joby says almost all of their trips in target markets would allow for recharging that takes about as long as deboarding and boarding passengers. According to one report, eVTOL batteries would ideally charge in under 10 minutes, about as fast as Tesla's latest superchargers. eVTOL companies hope safety measures will give them a leg up as they try and bite into the 10,000 traditional rotorcraft trips per day happening in the US. But first up, getting cleared to fly. A representative from the Federal Aviation Administration told Yahoo Finance that while eVTOLs could launch commercially as early as 2025, 2028 could be more realistic, at least for a scaled and competitive market. The FAA's Innovate 28 initiative outlines requirements for launch. That includes hitting certain safety criteria and flying under a variety of conditions. It's the same approach applied to traditional aviation. Still, certification is not guaranteed.
We don't know when certification for FAA will happen for any aircraft. The FAA changed them to special condition aircraft, essentially, putting more rigorous certification processes on top of that. So I can't imagine that we're going to see an eVTOL in the air certified flying around folks in 12 months' time.
Does pre-2030 seem realistic?
I do think late in this decade we'll have that.
Until then, eVTOLs are focusing on countries with looser regulations. Joby plans to launch flights in Dubai by 2025 through a deal that was supposed to be exclusive, though Archer, Joby's main competitor, later announced their own plans in the region. Back in the States, Joby's on track to hit the FAA's proposed timeline for approval. They've just completed stage 3 of a 5-stage trial. But with testing comes setbacks. The U.S. National Transportation Safety Board released a report on a Joby crash from February of 2022.
I know that there was a test flight that did end in a totaled Joby aircraft. Can you talk to me a little bit about what happened there and how you as a leader kind of transitioned the tech moving past that?
We were flying pretty high and really fast, right at the edge. We were doing it remotely though. So that's actually one of the really interesting early use cases of autonomy that I think is a little underappreciated. We've taken care of it in all of the future designs. But we found it earlier because of the use of that remote piloting and autonomy in a way that I think ultimately is pretty beneficial.
I think autonomous has its own issues, right? The fact that people will feel comfortable not only getting in an aircraft that they've never been on before and having it have no pilot seems like the riskiest proposition.
Still, autonomous flight could boost profits. Pilot salaries aren't public, but the average annual wage for commercial pilots in 2022 was a little over $100,000. That's according to the Bureau of Labor Statistics.
We think that's definitely going to come. We just don't think it's the right way to go to market to start with.
Sure.
Because this gets us to market as fast as possible. And then that's something that will make it even better down the road.
For now, Joby is partnering with companies like Toyota and even Uber, which sold off their own air taxi unit to Joby back in 2019.
I led the Uber Elevate team, which was Uber's effort to build a flying car, in some sense, ecosystem of different companies. We actually demoed this with helicopters in New York City in 2019 when we launched, maybe you remember, there was something called Uber Copter. You'll be able to in our app or in the Uber app, essentially choose Joby, a Joby flight, as one of the types of products. But it won't just be a flight alone, it's actually a multimodal integration.
That integration will be needed since Joby won't have many locations available for flights at the start. Here's how it would work in one of their first target markets, New York City. Users would open the Uber app and select the air taxi option. Then a car would come to the customer's door, drive them to the nearest vertiport, which is a converted heliport that can handle the charging and storing of eVTOLs. From there, users would hop in the eVTOL and land at a nearby airport. Joby says in New York City, the flight would take about 7 minutes. Uber isn't the only major company getting in on the action. Toyota invested nearly $400 million into Joby, and Delta invested $60 million. Archer, Joby's biggest competitor, has a $1 billion conditional order from United Airlines and raked in $150 million from Stellantis, as well as some well-known investors, including Cathie Wood via her ARC Innovation ETF and serial entrepreneur Mark Lorry. Major air taxi firms Joby, Archer, and Lilium have all had gains on the S&P 500 this year. To see this investment put to work, Yahoo Finance went inside Joby's assembly facility, which, following the Toyota investment, now runs a lot like a car assembly line.
So this overall is our final assembly facility. So we are bringing in all sorts of parts, all of the many different parts that go into the aircraft. Many of them get built here, and then we have a process where we put them sequentially in the right order, in some sense, onto the aircraft to build out that full aircraft. We are vertically integrated. We build the parts, and then we assemble the parts together into structures. And so what we have behind us is one of our structural assemblies for a fuselage, which is the body, the main body of the aircraft.
That vertical integration is part of what attracted Delta to Joby.
We spent at least 18 months looking at over 20 different eVTOL startups, really looking at what each one had to offer. Because of the technological strength that Joby had, the financial strength that they had as a startup, we felt that that made a great match for us to be able to collaborate.
It's not just airlines chasing the future of aviation. Honeywell, broadly known for things like thermostats, has an aerospace unit that's now making parts for eVTOLs.
What they've done is basically taken their partnerships onto eVTOLs by becoming a supplier. And that sounds like big investment dollars from Honeywell, but not so much because they're not touching their 27% operating margins. But instead what the company has done is tell partners that if they would like Honeywell to partner with them, they could invest in Honeywell's product innovation. We don't know the background of those agreements.
For major airline carriers like Delta, future investments into Joby are based on them achieving regulatory and financial milestones.
We have specific performance criteria. For us, it really is the performance metrics is just getting them to market and making sure that we're comfortable and integrating a seamless experience for our customers.
There's more than one path to get this to market. Rather than partnering with airlines, some eVTOL companies like Lilium are looking to sell to them directly. The German-based business, which offers a larger 7-person eVTOL, plans to focus its efforts on manufacturing and maintaining its aircrafts instead of owning the end-to-end experience like Joby. Regardless of the business model or investors, some common obstacles exist for all eVTOL companies, including infrastructure and adoption of the over 6,000 heliports in the country. New York City is poised to be the first to transition one into a vertiport for eVTOLs. The effort's not cheap, though. One firm's model suggests costs could range anywhere from $3.5 million to $12 million for a leading global city. Of course, that depends on a variety of factors like size and location.
What we are looking to do on this site with a number of eVTOLs is how do we embrace new technology, pivot to all electric, significantly reduce noise pollution.
So the end goal is a full pivot.
The end goal is a full pivot.
Infrastructure operators are putting in bids to transition this heliport into an electrified vertiport, one of 2 operated by the city. The plan is to convert both within a year of FAA certification, according to the mayor's office.
We won a very significant federal award, so some money will come from them. Some money will come from the bidders, who will have a long-term contract to manage the site, and some will come from the EDC.
Once they get FAA approval and find a way to build up vertiports, the next obstacle for the industry, scaling enough to keep costs down for riders.
So our goal is to actually launch this service at something like Uber Black pricing. On a per seat basis, though, not on a per vehicle basis. We think that as we are able to build up those muscles, the way the technology is able to efficiently batch people into the aircraft and make the whole operation work more and more efficiently, we'll be able to drive down toward Uber IXIC pricing on a per seat basis. And we think that really starts to get into that realm of like everyday flight.
According to Uber, the average price of a trip from Manhattan to JFK is $135 for an Uber Black and $87 for a regular Uber. However, Jeffries estimates that at launch, that Joby ride could cost around $200.
Do you have an idea of how many flights per day, per week?
Yeah, we haven't really announced any of the details on that.
One consulting firm estimates the cost per passenger kilometer will decrease by more than 2/3 between 2025 and 2040. But that's partially due to an expectation of autonomous flights in the future, which isn't without its own set of challenges.
So monitoring the FAA certification is the number one. What are the number 2 and number 3 headwinds that investors should be thinking about for eVTOLs?
Second would be infrastructure. I think we don't have an infrastructure in place right now, really. Where could you take this aircraft from? Could you take it from on top of your building? Will your building have the infrastructure for it? If you have to commute 30 minutes to the terminal that has it, does that defeat the purpose of just taking the Uber? Third, I think it's just customer apprehension to try an eVTOL. We just seek more customer awareness.
Joby detailed these headwinds and many more in an SEC regulatory filing from February. The company notes they have enough cash on hand to support the initial launch of commercial operations in 2025. But after that, if they're not generating sufficient cash flow, they'll use a combination of equity and debt financing to fund the business. Despite the financial obstacles and competition, if the eVTOL industry gains adoption, it has the potential to transform the way we travel, and that goes beyond just how we get to and from the airport.
It's easy to be negative on an industry that hasn't really taken off yet, right? So we want to be supportive of innovation, we want to be supportive of technology, but we also want to be cognizant of the current regulatory environment.
There'll be other things that we can do with these technologies that we're certifying. We're really building toward the future in a lot of ways as well. We're building all of these capabilities, all of these muscles as a company, not just to build one revolutionary airplane, but to build the future of zero-emission aviation.
Yahoo Finance's Wealth is your guide, your group of advisors.